Okay. So the first topic we are going to talk about, the first topic today is to go over chapter 11. And after we discuss this set of slides, we are going to have a student project related to this chapter. And this chapter is a very important chapter, is crucial in finance, and because of the coverage of a capital asset pricing model, or CAPM, is widely used on the Wall Street and by finance professionals. So it's a very important chapter. And there are a lot of concepts, calculations, and this is probably the only chapter, or one of those chapters related to investments in the typical MBA corporate finance curriculum. So if you plan on investment career, like to become an investment manager or portfolio manager or any kind of analyst to assess the mutual fund performance, this chapter is a very, very good starting point. And there are 8 topics here. We'll first look at how to calculate returns and volatility. And these calculations have been done in chapter 10. And if you are not familiar with, you can look at my YouTube video related to chapter 10. That is how to calculate return and volatility for one stock and for portfolios. Of course, today I'm going to go through those calculations again with you together related to the student research project. And then we'll look at the risk and return trade-off. Specifically, the project will be related to efficient portfolio frontier. And then we'll look at once we combine the investment with risk-free rate and loosen that short sale constraint, that is, you can borrow money or lend out your shares, etc. So you can go negative on a specific investment that is to short sell the equity. And we'll look at the relation between required rate of return and risks in the setting of capital asset pricing model, and looking at how to determine the risk premium. So that's 8 topics today we are going to go through. So I briefly discussed these topics last time. So specifically, if we look at here, A, B, C, 3 portfolios. So for a given return, we want to choose a portfolio that minimizes the risk. And if we look at a B, D, E, for a given level of risk, we want to maximize return. Okay, so for same return, minimize risk. For same risk, maximize return. And this blue line here is what we call a capital allocation line or capital market line. And we can construct a equation, because this is a straight line, a linear relationship determined by the intercept and slope. So we can construct something like this. And we are going to do that today in the project as well. So first of all, let's look at how to estimate portfolio returns. So portfolio returns, so first of all, we will calculate the weight of a specific investment. The weight is determined by the value of that investment and divided by the total value of the portfolio. Once we have the weights, and we have the return for each investment. Then the portfolio return is a weighted average. Weighted average. Let's look at this example. So we have 200 shares, and at this price. So what's the value? So that's the value of Coca-Cola stock is 200 shares times $30 is $6,000, right? So the others, oh, so that's Dolby, okay. 200 shares at this per share. Let's say okay, so this is a Dolby, okay. So this is one of those, and here let's say how many shares for Coca-Cola. Coca-Cola is 200 shares, 100 share of Coca-Cola. Okay, so here should be 100 share there. Okay. 100 share. Of Coca-Cola. So in total, this is a portfolio. This is a return one, investment one, and this is investment two. So 100 shares at 40. So it's a 4,000. So initial, this is the initial, okay, initial portfolio. Initial portfolio. Okay, and the total value is 10. Okay, 10,000. So you can easily calculate the weight for Dolby is 6,000 over 10,000. So it's a 60% and 40% for Coca-Cola. And then at time one, the dollar value change is dollar value change. So the portfolio value changed. So the weights will change as well. So if our stock's price goes up a lot, so its weight will increase in the portfolio. So these portfolio weights are dynamic. Okay. So let's look at if this goes up 36 and Coca-Cola falls by 38, what are the new values of the portfolio? So essentially, the new portfolio value would be the shares remain the same if you don't do anything, but the price will change. Okay. So it looks like the portfolio increased by 10%, right? So 10% return. And if you look at the new portfolio weight, increased, right? Increased. And the Coca-Cola weight will decrease from 40% to 34%. So this concept is very important. Even without trading, the weights change, fluctuate in a market. And here's another example. Suppose you invest in Ford and Tyco, and you expect 10% for Tyco. What's your portfolio expected return? So your total investment is 40,000, and the portfolio weights would be 10,000 over 40, 25% and 75%. And here we need to know the return for each race. Okay, so 10% for Tyco, and then what is the expected return for Ford? It's let's say it's 10% for Ford and 16% for Tyco. Okay, so it's return. Okay, so so now you can see that when we go through the set of slides, if there are any errors will adjust accordingly. Okay, adjust and fix those errors accordingly. So that's one of the abilities. I'm sure if if you are a manager, or if you are going to be a manager, a financial manager at a firm, you are going to have several people report to you, and then if they prepare the materials or slides for you, then you have to have the ability to fix any errors on the slides. Sometimes you just strictly under time pressure and on the spot, you have to be able to fix and explain. And that is one of the abilities. So, and you can see, in the set of slides we have to develop the ability to, this is what we call critical thinking. Okay. And rarely you have everything perfect. So we have to be able to use our knowledge to find out what is right, what is wrong, what is the correct way of calculation, and especially dealing with data and information. In today's world, the data, is all over the place, and sometimes you have fake data. You have to be able to, use your judgment. So that is very important in today's misinformation battle. But anyway, let's continue. So this is a 25% in Ford and 75% in Tyco. So the point here is once you understand the calculation or the logic behind these examples, then you'll be able to fix any errors. Okay. So here we have the weight. We have the expected return for the 10%, Tyco 16%, and weighted average, so 14.5%. Okay. And the volatility of a portfolio. So in this case, when we talk about a volatility of a portfolio, it's related to distributions. And it's over time. In this case, you see over time the returns change, fluctuate, and the volatility is a measure of that fluctuation. The more the fluctuation, the higher is the volatility, the higher is the risk. And in this case, you see these three investments have the same volatility. And it's the same return as well. However, when you combine them together, half north air, see half north air, half west air, this portfolio equally weighted give you a return 10% but a risk of 12%. Whereas this portfolio give you a lower risk. So which one is better? So for the same return, we prefer to have a lower risk. So this is better. That is one. Another observation is you look at this portfolio risks versus the individual stock risks. You see, by combining stocks into portfolios, the risk reduced as well. So that's what we call a diversification. And the reason that the north air and west air, the volatility is not reduced dramatically is because of the correlation between the two. So if they are highly correlated, then the reduction is less. If they are not highly correlated, or if they are negatively correlated, then you have more diversification effect. By that I mean the reduction in volatilities. So that is the return and volatility calculations for a single stock and for portfolios. And when we have a portfolio of several stocks or a lot of stocks, or portfolio could be a combination of different asset classes, like you have a house, let's consider real estate, you have bonds, you have stocks, then 3 assets, then you can form a 3 asset portfolio. So all of us have portfolios, okay, portfolios, and your human capital is part of the portfolio as well. And in this class here, in this chapter, we will mainly focus on stocks, but don't limit yourself to stocks. The portfolio concept can be extended to include any combination of assets, no matter it's stocks, bonds, real estate, human capital, and anything it could include. So to find the risk of a portfolio, we need to know the degrees to which these stocks or these assets move, how they move together. And we'll use the concept of covariance. So what is covariance? Covariance is the deviation of these 2 assets. This is 2 assets, okay? How they covary, okay? So this is the mathematical calculation. And in Excel, you can easily just do a covariance formula. But you can also use the mathematical formula. And here, you look at here, the first one is the deviation for stock I. This is a deviation for stock J. And multiply together. Okay. And then you get you'll be able to calculate the covariance. So essentially, if it's over time, then you just sum them together, okay? Sum this together. And the covariance, if it's a positive, they move in the same direction. If it's a negative, they move in the opposite direction. And another concept is correlation. Correlation is nothing but a standardized covariance. So covariance can be any number. However, correlation is between a -1 and a +1, standardized by the dividing the standard deviation of the 2 assets. So if we look at this chart, if it's uncorrelated, the correlation coefficient is 0. If it's always moves together, it's +1. Always move against each other is -1. And most likely something in between. So a takeaway here is if you pick stocks from the same industry, like Facebook, Twitter, Apple, Microsoft, these technology stocks tend to move together so that they offer limited diversification effects. Whereas if you choose Apple, Johnson & Johnson, 3M, these type of firms in different industries, they are all from US, but they are from different industries. The tendency to move together reduced, so that you have a better diversification effect. That is why Dow Jones index has 30 firms from different industries, mostly, okay, and representative. If Dow Jones focus on just one type of industry, then it's not highly diversified. The covariance and the correlation of a stock with itself, the correlation is 1 because one stock with itself is perfectly go up, go down, goes down. And the covariance in this case will be the variance. If you see here, and the correlation coefficient is 1. Let's look at how do we calculate this. So the covariance, as I mentioned, is these two deviations, the two deviations multiplied together. So you have this deviation and you have this deviation multiplied together, you get this number, okay? And through time, you have this, okay? And then you sum this together, you get this, this one, okay? And sum, you have to do an average, okay, average. So this average process, divide by t minus 1, because you lose 1 degree of freedom, you get this is a covariance, okay? 3 steps, okay, 3 steps. The first step is calculate the deviations, and then you calculate this sum, and next you do the average. And for the correlation coefficient, once you have this number, you divide by the standard deviation of this two standard deviation of this, and you get and this. So divide by those two standard deviations, you get the correlation coefficient. It's always between -1 and +1. So apparently, the West and T, these two, has better correlation, has better diversification effects because of negative correlation. And also you can see it's from the different industries. And these two are from the same industry, so they move together. So once we get past the covariance, we are going to look at covariance, how to do those calculations in Excel for the project, okay, in a little while. And once we get past covariance, we can calculate the portfolio's variance and volatility. There are 2 ways we could do this, 2 ways. One is to calculate the variance based on the covariance matrix. The other is just get the portfolio returns and expected returns and use the expected return deviation method to calculate the variance. So here, the first one is to look at the variance, covariance. So you have this is a variance, and this x are the weights, okay, are the weights. So it can be simplified to this equation. Alternatively, you could do, let's say, you could form a portfolio. You could form a portfolio and have the portfolio's returns and look at the return standard deviations or variances. So let's look at one example here. Suppose we know the standard deviations of this, and if we know the correlation coefficient, what is the standard deviation of the portfolio? We just plug in the equation. So the standard deviation, 43% will get squared to get the variance. And here, squared to get variance. These are the weights. And this is weights. And the covariance is nothing but the correlation coefficient. And standard deviation 1, standard deviation 2. So 2x1, x2, right? So this type of calculation, if you have to practice a little bit in order to really do it right. And another method of doing this is just form this portfolio form this portfolio and then you calculate the portfolio return across time, and then you'll be able to calculate the portfolio variance. Volatility of a large portfolio. When the portfolio gets bigger and bigger, you see that the volatility tend to decline. And you can see that this is quite complex, this formula. And this complex formula can actually be simplified quite a bit. I'll just give you one example. Suppose we have 3 stocks. Okay, 3 stocks. Okay, so suppose we have Apple, let's say Coca-Cola, 3M. Okay, so and we can do Apple, Coca-Cola, 3M here. If Apple is W1, the weights, W2, W3, right? These are the weights. If Apple's variance is this, or variance covariance. If we say covariance, the covariance of Apple and Apple would be, let's say, do I have a eraser? Let me erase this. Okay, so if this covariance is R1, it's nothing but just the variance of Apple, and here would be a covariance of R2, right? The variance of Coca-Cola, the variance of 3M, right? And here would be the covariance of R1, R2, right? And covariance of R1, R3. If you look at R1, R3, right? And then here would be covariance of R2, R3, right? And here is the covariance of this is 2 and 1, right? Covariance of R3, R1. Covariance of R2, R3, R2. Okay, so if you look at here, we have a 3 by 3 matrix, 3 by 3 matrix. If you just multiply this weight with this weight and this number, you get one of these items. And then you do next, W1, W2 times this. So you get another item. So altogether, you have 9 items together. So if we call this a vector, W, it's a vector of weights. And if we call this one in the middle, if we call it a variance, covariance matrix, let's use omega. So if you just transform this, transpose these weights to vertical, so you transpose it, okay, or you just say T, okay, and then use this multiply by this covariance matrix, and then this would be the portfolio variance. Okay, so in Excel you can just use matrix multiplication to solve this problem, and I'm going to demonstrate that in Excel. And once you understand the concept of 3 stocks, you can extend it to 5, to 20, to hundreds, right? If you have 5 stocks, would be 25 terms, right? 25 elements in this matrix, right? If you have 2, it's simple, right? 2 have 4 terms. If you can look at here, 2 has a 1, 2, 3, 4 terms. 1, 2, 3, 4, right? If you have 3 stocks, you have 9 elements. So diversification with equally weighted portfolio. Equally weighted, that means 1 over n is the weight. Okay, equally weighted. So if 3 stocks would be 1 over 3, 33% in each asset. And when we are adding more and more stocks, we will observe that portfolio volatility tend to decline. Once you add past 20 to 30 stocks, you can no longer diversify, reduce the risk. So that's a market risk. And I hope you can reproduce this kind of chart if you replicate this. If you have extra time, okay. And if we have time, we'll do something about this as well. Volatility when risks are independent. So if they are independent, that means these terms are zeros because there is no correlation because they are independent. So the correlation is 0. Okay. Then it's simple. Then it's just the average of the variance. Okay. Diversification with the general portfolios. So for a portfolio with arbitrary weights, so any weight, okay, we could calculate the volatility of a portfolio with arbitrary weights here. So this is a security I's contribution to the volatility of the portfolio. So for that I, okay, I, and then you have the remaining part, okay, remaining part of the portfolio. So unless all of the stocks have a perfect positive correlation, otherwise if it's not perfect, then you are going to observe the risk of portfolio is going to reduce. And we are going to have a project, individual project, going through the efficient portfolio. Basically, we are going to build a portfolio efficient frontier. So basically, we'll look at how to construct those with 2 stocks and with 3 stocks. And I'm going to demonstrate that after the break and the project will be just replicate what I have done using either the same stocks or using different stocks. And I think it's a very important exercise. So we are going to build something like this. This is Coca-Cola and Intel. So the point is to calculate the return and the risk for each portfolio, each combination, and then plot this. For 2 stocks, that is what we call the two stock efficient frontier. Okay. And if you have 3, then the exercise is a little bit more difficult. It's more difficult. Okay. So we are going to look at this. So here we look at if they have a perfect correlation, if the two stocks perfect correlation, it's a red line become a straight line. If it's perfectly negative, then it's a kinked line. Okay. And if the correlation is between -1 and +1, it's any curve in the middle. And in this exercise, we have all of the investment had positive weights. And it's also possible to have negative weights. That is what we call a short position. Short position. So you sell something you do not own, and you hope that the price will decline, so you buy back at a lower price. Okay. I would discourage short selling. Okay, if you are doing your own investments, I highly discourage that, unless you really know what you are doing, because you could lose a lot. Say you short sold like Tesla at $100 per share, then it goes to $200. You lost $100 on each share. If it goes to $1,000, you lost $900. You kind of you are going to have astronomical losses, and of course you could lose your entire account value, and then the broker will liquidate your account. So that's very risky. And we are going to look at the effects of a short sale. But a short sale, if you do it right, it does improve your portfolio performance. Okay. So with a short sale, you can extend the portfolio frontier by these dashed lines. Okay. And the next exercise would be efficient portfolios with many stocks. And here we have 3 stocks. Okay. And we could construct a efficient frontier for each combination of 2. Okay, combination of 2. But that's not the purpose. The purpose is to get to the combination of the 3. So here the red curve is the combination of 3. So in the individual product, we are going to construct this portfolio frontier is a red curve to build up this red curve. And you can see that a red curve is better than, because if you just draw a line here, any line here, for the same risk, so this red curve has the highest return, or for the same return, the red curve has the highest lowest risk, so it's superior than any other combinations. That is what why we call this efficient frontier. So efficient frontier. And here we have even more stocks. We have 10 stocks here, and the construction of this frontier. If you know how to do 3, then really it's just a matter of expanding it to 4, 5, 6. So the project is to do 3, but you can at your spare time to do more, include more stocks. So here it has nothing to do with risk-free rate. Once we have a risk-free rate, then the entire equation will change. So the risk-free rate suppose is somewhere here. Okay. Suppose it's here. Then we can draw a curve. Okay, draw a curve tangent to this line. You see this new line will be better than any portfolio below this line. So this becomes the new capital market line or the capital allocation line. So we are going to solve this kind of problems as well in the project. So with risk-free rate and also with borrowing, so short sale is allowed. So there are some calculations here, and we are going to do all of these calculations in the project. You see, if this is a risk-free rate, and you can go up or go any line until you reach a tangent line. Okay, until you reach a tangent line. So I'll skip this example. And how do we identify the tangent portfolio? So really, you have this curve, right? This line, okay, this green line. So how do we identify this one? So you just need to look at the slope of this, the highest slope, the one with the highest slope, yet touches this efficient frontier. That will be your best bet. And here we are going to have a new concept called Sharpe ratio. Sharpe ratio is used widely in the investment industry. Sharpe ratio is a measure of, let's say, it's a reward to risk ratio. So for a certain risk, okay, for a certain risk, what is the extra return or the excess return? So Sharpe ratio. So if there are two mutual funds, they have the same return, but one has a lower risk. Then the Sharpe ratio will be lower. Okay, will be lower for one of those investments. I'll let you think about whether higher number is better or lower number is better. So let's take a look at that Sharpe ratio. Okay. So this is what we call the excess return. Excess return. If we have excess return over the standard deviation, this is what we call the Sharpe ratio. So for the same risk, the higher the better. So the higher the Sharpe ratio, the better it is, the investment. So back to that two mutual funds. Okay, two mutual funds. The one has it's the same excess return. The one with a lower risk has a higher Sharpe ratios. So you should pick investments, mutual funds with a higher or better Sharpe ratio. The last couple of topics are related to beta. Beta, in this sense, is a covariance ratio. If you look at here, it's a covariance divided by variance. So beta measures the portfolio I, sensitivity of portfolio I with respect to portfolio P. And if this portfolio P is a market portfolio, then we call this is a beta. So we can use the and that is what we call the capital asset capital market capital asset pricing model. Okay, and this P if is a market. So if that's a market portfolio, and we can use the CAPM equation to do calculations. We can see that here risk-free rate and excess return and beta. If we have these numbers we plug in, we can do these calculations. So with the risk-free rate, the efficient frontier will be improved. Will shift up, okay, upward. Let's look at Sharpe ratios, and I'll skip this part. Capital asset pricing model. There are several assumptions, and there are more than 3, but these 3 are the main assumptions. So one assumption here is a competitive market, and that means no transaction cost. And also assumes the investors only hold efficient portfolios, but a lot of times we don't. And also investors have similar expectations. And overall, if you think of the market as a whole, it should be balanced by supply and demand. Okay, supply and demand. So that's the argument for the market portfolio. So I'll skip this part, and we are going to come back in the project to these calculations. So this is what I talked about. From the risk-free rate, draw a tangent line to this curve. That is what we call the capital market line. And if you look at this line, relative to anything below it, you can have a lot of things below it. So the portfolios on this line will be superior relative to all of the portfolios below that. Okay. So theoretically, all of us should hold the market portfolio, just invest in the market portfolio, and have a peaceful mind. And that's exactly, you see that index investing have picked up pace, and a lot of people just put their money in index funds. So what is a risk premium? Risk premium is a compensation for the risk, for the extra risk. So if there's no risk, so it's a risk-free. If it's risky, so whatever extra relative to the risk-free is the risk premium. So what is risk premium? So basically it's RI equal RF plus risk premium. Okay. So this risk premium in this case is equal to this part, okay, this whole equation here. Okay, security market line. Security market line here, you look at is a plot of excess return, expected return. So this return versus beta. So the difference between security market line and capital market line is the axis. So if the axis is the portfolio standard deviation, then it's capital market line. If it's beta, then we call it a security market line. In the security market line, you'll find out all of the securities. So all of the securities, okay, on this line. And here is what we call a capital market line. So the axis is volatility, whereas here is beta. So this is what we call a capital market line. And once you plot return against the beta, it's called a security market line. So beta is really portfolio is just a weighted average equal to W1 beta 1 plus W2 beta 2 plus W3 beta 3, etc. So beta of a portfolio is relatively simple to calculate. It's a weighted average. Summary. So the market portfolio is an efficient portfolio and risk premium is proportional to beta with the market. And there are 3 appendix slides. I'm going to skip those. Okay. And we are going to take a 5 minutes break. And when we come back, we are going to do a individual data case or project. And I'm going to write up the project with you. And if you have any questions, you can discuss with me. And I'm going to show you at least how to do a lot of calculations using data we are going to pull from Yahoo Finance. So let's have a 5 minutes break. Now it's 12:57. Let's come back at 3:02.